Hi, it's Liz Gaines from GigaOM here today to interview Chris Sacca, who is getting serious about angel investing and becoming a VC, raising a fund.
Very serious. This is my game face, you can tell.
And you're now the proprietor of Lowercase Capital. And what does that mean?
In terms of lowercase capital or the proprietor or like what my role is, I mean, definitely at its essence, lowercase capital is a way of life. No, I'm just kidding. It's a family of funds, some early stage stuff, some late stage stuff, some primary stuff, some secondary stuff, but it's just basically the label I've put around all my investing and advising activities.
Which you'd been doing more informally for a while now, or what,
Yeah.
What was before the funds?
I did a couple angel investments when I was at Google. And then in the years before then, I'd been involved with startups. I'd been a startup lawyer, been an executive in an early startup that we sold and stuff. And so I got to Google, and while there, it was fun to be part of a company building awesome products and getting to start new products within that company and shepherd them all the way through. But at the same time, I missed that startup environment. And I missed learning lots of different things at once. And so while at Google, I got a chance to invest in PhotoBucket. Very cool.
Investment.
Yeah, that was my very first investment. In fact, I wrote a credit card check to invest in PhotoBucket. I didn't really have any money, and so, but that turned out to be a great investment.
Yeah,
my second
I remember
investment.
when I think the first time I met you was you spoke at a Red Herring conference and you just couldn't stop talking about PhotoBucket.
I was pretty fired up. That was just one of those things where the numbers were amazing, and I think none of us in the Valley were paying attention to those guys, and yet they had 68 million users, and it was just like, it was kind of funny. We were in our little Flickr echo chamber, and PhotoBucket was just blowing it out of the water. Red state, blue state didn't matter. People were actually using it.
Yeah.
And so the second investment I made was Twitter, and I was still at Google at the time, but just always been a good friend and a fan of Evan Williams. And so when he started Twitter, I was just in. I got it. And I actually just got a note yesterday that yesterday was my 4-year anniversary of tweeting. So it's kind of amazing to think that service has been along that long. No, like there's a bot that figured out I'd been tweeting for 4 years and it sent me a replying message, but I was like, that's pretty rad. Like 4 years of that. Yeah. So, and then from there, as I left Google, I just started to kind of formalize it a little bit more. It was still investing my own money, but just getting more and more involved with a wider range of startups. Sometimes as an investor, sometimes as an advisor without putting my own money, just taking equity in exchange for guidance and strategy and product design and stuff like that.
When you left Google, did you think you were going to be an investor, or were you looking for the next thing?
No, I thought I was going to be an investor. I thought I was going to be an advisor. I wasn't looking for the next big company job. I'm not very good at big companies. I don't play the political game very well and stuff like that, and I make too much noise, and so I knew I was going to end up working for myself. What I didn't know was whether I was going to put that to work in early stage startup stuff or whether I was going to go bigger, late stage, public, private equity type stuff. Like, right before I left Google, I was running the Spectrum division, all that wireless stuff we were doing. And so that was billions of dollars that we were taking to the FCC. And so when I left Google, one of the paths I took was I started working with big, super multi-billion-dollar funds to go after more Spectrum, like continue the work I was doing at Google. And so,
So you wanted to do something on that scale?
Yeah, there's something really tempting about that. It's amazing you're changing the world, and yet at the same time, people are wearing suits, and it's all bankers and lawyers and stuff like that. And it doesn't compare to the grittiness and the excitement of being in a room with a couple of guys who are starting something on no money at all and have the same aspiration to change the world. And so I feel like I've been lucky that I've been able to do both. I've been able to split it. Yeah.
So now when you're talking about lowercase capital, you're saying funds plural.
Yeah.
I don't know what that means. Can you explain this?
Yeah. So what I think in the Valley I'm known most for is early stage stuff. So I've got like an early stage primary fund that basically does anywhere from $75,000 to $300,000 investments in traditional startups, just really early seed stage type stuff.
First round stuff?
Yeah, first rounds their offices are upstairs, right? Yeah,
no,
but
round.
I collaborate with those guys a lot. But no, it's always seed. But it's always seed round stuff like that. So, valuations between $1 million and maybe 3.5 or 4, that kind of realm. I have another fund that buys stock from founders pretty early on. So you hear people in the Valley always say, look, I want my entrepreneurs to be hungry. And I agree with that. But I think there's a difference between being panicked and being hungry. And I think too often entrepreneurs find themselves with negative net worth, credit card bills, et cetera, and they get freaked out.
Is this the Sean Parker style stuff?
Yeah, so Parker and those guys are geniuses, number one, the founders guys. And the Class FF stuff was interesting. It was intended for a little bit later stage, though. The Class FF was intended for like a Zuckerberg. Like, he's got a multi-billion-dollar company, no one wants it to sell too early, so let him take $10 million off the table and keep blowing this thing out. And it makes a lot of sense to do that.
And it's become almost common practice.
Yeah, I take it earlier than almost anybody, which is, I feel like there are 3 points that matter most. When you go from debt to $0 of net worth, that's like a huge weight off your shoulders, right? You're like, oh my gosh, I have choices in my life now. I could go to the Peace Corps and no one's gonna chase me down. So when you move from $0 to like $30,000 in the bank, at $30,000, my founders know that even if that company fails, they don't have to move back in with mom and dad. And so suddenly they start to relax and look a little bit longer term. And then if I can move them from $30,000 in the bank to 150K, and 150K, suddenly they're like eating in restaurants from time to time. If they're in San Francisco, they have a car. They can plan their vacation a few months out, you know. And
so how is that different than buying traditional equity in a startup?
Because when you buy traditional equity in a startup, the money doesn't go to the founders, it actually goes to the company, which is important, right?
So you buy shares that have already been allotted to the founder?
Yeah, yeah.
Okay.
And so it's common stock, you know, it's usually discounted to the preferred because there's that preference overhang on it. But again, it's to the tune of like $50,000 to $200,000, depending on the scale of the company and where it is. And it's intended, you know, I have one company where 2 founders, one has made money in a prior startup, the other hasn't. We got an offer to sell the company, and you know, at a profit, but not anything too exciting. The founder who'd never made any money before was kind of inclined to sell the company, right?
That's the game changer.
Yeah, exactly, because the guy has credit card bills, you know. And so when we really looked at that, we were like, as a company, we're finally starting to like see traction and momentum. Why would we want to sell now? And when we kind of dove into the psychology of it, you know, that founder is just like, look, the few $100,000 I might see in that deal means a lot to me, right?
Do you think that this is a long-term strategy, or when the IPO market comes back, it won't be relevant anymore?
No, I do think it's going to matter a little bit. I think what it is instead of binary outcomes, what we're starting to do is realize that founders need some kind of comfort, a little bit of a hedge to make sure that this isn't an all or nothing. You know, as a venture capitalist, it's sometimes just disingenuous, I think, for some VCs to sit there and say, okay, let's do this, let's roll the dice, let's go for it. You know, like, you've heard the phrase pulling a Patzer. Like, people are all over Aaron Patzer, the guy who started Mint, for selling for $173 million, and people claim he sold early. Like, that's just bananas to me, right? And so forcing these binary outcomes,
I mean,
it is. Really mean anything. Yeah, but in a fund, in a big VC fund, you need these massive billion-dollar outcomes in order to move the needle of a big fund.
That's what matters for them.
And so if they, I feel like if they really want their entrepreneurs to push to that level, they have to give them opportunities to take a little bit of money off the table. You saw that in the Foursquare deal. Just today it was revealed that Dennis and the other co-founders took like $4 million off the table out of the $20 million that was raised, right? And so I think that puts those guys, I mean, I'm not speaking for them and I'm not in that deal, but my perception is it puts those guys in a place where they're a little more chilled out and can be like, okay, let's go build the multi-billion-dollar company that we've all set out to build here. You know, and I think it actually, in a funny way, aligns investors more. And yet, what you'll see is there's a lot of vitriolic opposition among traditional VCs who are like, screw that. Like,
what about what it does for other employees, like especially really early employees?
Yeah, well, I mean, generally, I think it's the rounds where I'm doing it, it's an A round, and we're working with founders who have the decision-making power to either go the distance with this company or not. And I think early employees, by the time they get hired, they're usually making a little bit of money. Founders often aren't making any money at all in the beginning. They go into debt, you know, that kind of stuff. And so I think early employees kind of know the deal they're signing up for. And founders, I think, find themselves in this strange hole. And I'm just trying to address the basic psychology of that. You know, in 2001, I lost my job. I was deeply in debt. I was freaked out. Like, I wasn't making good decisions. I didn't have a lot of options, you know. By 2005, I had made it back to zero finally. And I finally felt like, okay, what do I want to do? Like,
it's like going to the grocery store when you're hungry, right?
Yeah, it's exactly right. And so if I can take the panic out of these guys a little bit and help do that, suddenly I find we're building companies. We're really looking ahead and not just dealing with the week-to-week triage of what are they going to do in their life.
So who have you done this for so far?
I don't talk about it that much because it's kind of a personal thing. Yeah, I think I've done 6 of these so far. So all in existing portfolio companies of mine. It's
and
a pretty
you have
personal
the same
thing.
investors in the fund that does that?
Yeah.
That's separate.
Yeah,
That's
yeah.
separate from what you
Right. So I have that. I have another vehicle that that buys secondary shares from companies like Twitter and stuff like that. So so early employees or early investors at companies like Twitter who are looking for a little liquidity, they sell me their shares.
So that's the third thing.
Yeah. And then I have late stage funds. So that I'm partnered in, not under the Lowercase brand, but Lowercase is the partner in them. And so we do big public company take privates and stuff like that.
Oh,
so,
really?
Yeah.
With someone existing?
Yeah.
Okay.
Yeah. So that's exciting stuff too. And so we have
like a Silver Lake kind of thing, or what? Like
no one out here. So they're New York based, but we have Hollywood assets, we have
keeping
transportation
secret,
assets.
you're
Yeah. So, but we have wireless assets, that kind of stuff. So, so it's fun. It's really late stage, really early stage.
But you're the only person on your website. You're the
Yeah.
You're the guy.
Well, I have a COO who works remotely
Are
from
you staffing
Healdsburg.
up?
I don't know. Like, yes, it'd be nice to have somebody help with this stuff, but I don't know if I'm organization building, you know.
Yeah.
And this might be a natural, like a limit on the natural size of Lowercase. I mean, right now, like a lot of the VCs who I really admire still have investment committees that they have to go through. And I can kind of make a decision immediately. And I feel like that's a competitive advantage where it's competitive, and it also kind of puts me in a place where I can invest on instinct and gut more than a lot of analysis and like over Excel jockeying something. And so I feel like that's actually helpful to me.
Yeah. So one thing I want to ask you about is I know you've been pretty vocal in this active online discussion about super angels and is there an oversupply of them and is traditional VC dead? And I feel like well, I'd be interested to know since that's settled down a little bit, where do you think all that falls?
Yeah. Well, I mean, on my website and the at lowercasellc.com/creed, I kind of wrote the basic premise of my fund is that a lot of these traditional funds have too much money to try and invest in the web, and certainly not to be the first round investor in a web.
Just because web companies are cheaper.
It's orders of magnitude cheaper from where it was in 98, 99. You needed a couple $1 million to write your first few lines of code. You needed proprietary boxes, proprietary development environments. Bandwidth cost $2,000 a meg back then, And so you fast forward to now, and you see these companies come out of Y Combinator. I mean, I helped sell one a couple years ago for $15 million that had raised $14,000, right?
Was
like
that,
their
YouTube one?
Yeah. So their top line expenses were rent and food.
Yeah.
Not servers, Amazon should get even more credit for everything they've done to, with AWS to fuel this advance, but it's just not that expensive.
So how will you measure your success then, though? Like, because the precedent that you're matching up against is the traditional one, right?
Yeah. I mean, look, I have no money allergy. I'm a big fan of money, and so are my entrepreneurs, right? And so this isn't like a hippie enclave or anything like that. But it's an admission of the reality of the economics just don't work. And they actually, in these bigger funds, they actually create this division in between an entrepreneur and the investors, because the investors have to drive towards these huge billion-dollar outcomes. And along the way, there may be a lot of outcomes that are really good for entrepreneurs. So I sold a company just a couple weeks ago that hasn't been announced yet because it was a public buyer who wants to time the announcement right for their investors and stuff like that. But it was a $2 million pre-money valuation. We sold it for $20 million. 3 guys, pretty amazing, right? And yet I was at dinner with a well-known billionaire investor who's like, "What does that do?" And I was like, "I'll tell you what it does." I have 4 or 3 25-year-old entrepreneurs each holding a check for $4 million who are totally freaking thrilled, who are really happy that the couple years they put into this thing makes them feel good. I just did 10x on my investment. We all feel great about it. Even though it doesn't move the needle in a massive fund, it was great for my investors. And so, it's 10x.
Where do you make the decision about what's a big long-term play then?
In terms of companies I invest in? Well, Twitter is a long-term play. I mean, and I continue to actively buy Twitter despite it being a big $1 billion+ valued company. I think that's, that wasn't built as a flip. It's a long-term company that may go public. It may just continue to throw off cash. I mean, they're starting to turn on business models that are pretty fascinating right now. But, and so I'm not trying to say I invest in things that are intended to be flips necessarily. I just think that a $20 million sale of a company that was valued at $2 million and it's still 80% owned by the founders is a really interesting outcome for the founders, and it should be an interesting outcome for me too. And yet, in traditional companies, that's not often the case. I saw 2 years ago now a company that raised 3 on 7 to make a 10 post. And 6 months later, they were offered $37 million to sell the company, and the Series A investor blocked the deal. And you're like, wait, it's a lot of money, right? Like everyone's making upside on that deal, and yet Series A investor was pretty clear, like, no. Like, this is the best investment I got in my portfolio, and I know we're going to change the world with this thing, so let's go. And
what happened?
and so it's hard to say because it kind of reveals who that company might be. But it's it's frustrating.
Up or down?
I can't say, but it's just kind of frustrating because I feel like these bigger funds need to push towards some of those outcomes, and that's where they lose touch with the entrepreneurs a little bit. I do think the secondary stuff starts to bring them a little closer together if you can kind of de-risk the entrepreneurs a little bit in conjunction with the scale of the opportunity. But generally, with an $8.5 million early stage fund like I have, if we sell a company for 3-4x a few $1,000,000 bucks, that's great for everybody. My investors love it. My entrepreneurs are happy. I'm totally happy. It's good for everyone.
Do you expect them, though, to like roll out of the company that acquires them a couple of years later and do another startup?
Maybe, yeah. I mean, this valley is small, right? It's funny, I got laid off in 2001. I was a lawyer, strangely enough, and 18 months later, I was the general counsel of my law firm's second biggest client. And it was great. When I was laid off, they were very cool to me. I mean, they laid off like a couple hundred people that day. And they were very cool. And so strangely enough, like I had a lot of loyalty to them. And so, the valley was just that close where all of a sudden I'm the guy sending all the money to these people who had literally fired me 18 months earlier. You kind of learn that lesson early on. This is a really small valley, and that people who you're working with now, I mean, think of how many ex-Googlers have gone on to start companies now, right? And I had the privilege of working with them then, and I have the privilege of investing with folks now and stuff like that. It's just, and the serial entrepreneurs just keep coming back to the table and keep doing new stuff. And so
you have 39 investments to date?
Yeah.
What's the pace?
I don't plan that kind of stuff. Maybe if I had some more interns, we would have spreadsheets that say that. If I see really cool stuff.
Summer intern window.
Yeah, I know, I screwed that up. I would need somewhere for them to sit, and I don't have that either. As I'm based in Truckee, up near Lake Tahoe, so I guess I have a spare bedroom up there. Somebody could come kick it in the mountains with me. But
Could be worse.
Yeah, I guess. Yeah, now I'm thinking about it. Kind of nice. I should put the ad together. But generally, like, I don't know. I'm putting money to work as exciting stuff comes up, and I don't always see deals first. There's this great network of people that will bring me deals and stuff like that. So sometimes I'm a little late to the party, but they'll make room for $100,000 for me or something like that. And then there's a few things that I find that I think are just amazing that I then go share with others and stuff. So I don't have a good sense of the actual velocity of it right now, but let's say I think we're almost half invested on that $8.5 million fund though.
Already?
Yeah.
Wow, that was fast.
Yeah. Well, one of the ways I started was by putting in some stuff I had invested in myself. So I own 10% of that fund that I just transferred in on my own, and so we've already got stuff in there and churning along, and yeah, it's pretty cool. I mean, I've been investing the money from that fund since November. Yeah.
Still, $4 million since November is not.
Yeah.
Not
No,
too
it's
shabby.
fun. There's just a lot of cool stuff out there right now, so I'm pretty excited.
Awesome. Well, thanks for coming in and speaking with us.
Yeah. Cheers. Thanks, Liz.